$2.6 billion. That's how much was erased from the crypto market in 24 hours, when Bitcoin's most defended level, 69,000, finally broke. The headlines called it panic. Social media called it fear. But when we pulled the forensic data, nothing about this looked like panic. This was clean. This was quiet. This was an execution. And the evidence points to something most traders completely missed. February 5th, 2026. Bitcoin had survived an entire market cycle above 69,000, the prior all-time high. The psychological fortress, the line in the sand that every bull believed was untouchable. In less than 12 hours, that belief was shattered. Over half of the 2.6 billion in liquidations happened in a single concentrated window. No drift, no gradual breakdown, a structural snap. Usually, panic is messy, it's fragmented, it's loud. But this was silent, efficient, surgical. And in this business, when markets don't behave the way the story says they should, that's usually where the real story begins. Everyone's asking the obvious question: where does price go next? But that's not the interesting question, that's gambling. The uncomfortable question, the one that actually matters, is this: what kind of force is strong enough to break a level that survived an entire cycle? Because price doesn't break major structural zones on belief alone. Support levels like 69,000 don't just give up. They have to be demolished. So instead of guessing direction, we went back to the scene. We started reading what the market left behind. And the first clue, it was sitting right in plain sight, in the pipes of Wall Street. If this had been a retail-driven sell-off, you would expect chaos, fragmentation across exchanges, Coinbase lagging, Binance crashing, uneven pressure. That's not what we found. On the same day, Bitcoin broke 69,000. BlackRock's Bitcoin ETF, IBIT, recorded the highest trading volume in its history, $10.7 billion, nearly double its previous record. Let that sink in. This volume didn't happen after the crash, as bargain hunters stepped in. It happened as the structure was failing. Now pause for a second. If you've been watching financial news, they told you this was retail panic. Does $10 billion flowing through an institutional ETF rail sound like retail to you? ETF volume of this magnitude appears only when large positions are being adjusted or forced through the most liquid door available. This triggers a mechanism called creation and redemption. When selling pressure is this extreme, the ETF issuer is forced to sell the underlying Bitcoin to maintain the peg. This wasn't a community vote, it was a process executed by the street. But the ETF wasn't the only signal. Something in the options market was already flashing red before any of this happened. Here's where the timeline gets interesting. Forensics is about sequence. What happened first? Before price dislocated, before the chart looked broken, the options market flashed a warning. IBIT options volume surged. Nearly $1 billion in options premium changed hands ahead of the break. Why is this the smoking gun? Because options aren't traded for reactions, they're traded for positioning. Smart money uses options to hedge downside risk before the event occurs. When options activity accelerates before spot price breaks, it tells you stress existed before the market admitted it. Gamma exposure was building. Market makers were being forced to hedge. Something underneath was already cracking. Price just hadn't caught up to reality yet. Next, we examined correlations. In a typical crypto panic, liquidity dries up unevenly. Some coins crash 20%, others 5%. Pure chaos. But look at this: Bitcoin, Ethereum, Solana, assets with completely different risk profiles, fell in near-perfect synchronization. That's not fragmentation. That's portfolio-level unwinding. When assets with different betas move at the exact same rhythm, it means one thing. Someone wasn't picking coins to sell. They were reducing total exposure. They hit the sell basket button. This wasn't a series of independent trading decisions. It was a balance sheet being lightened by an algorithm. If you're connecting these dots, the ETF volume, the options activity, the synchronized selling, drop a comment below. I want to know. Did your exchange show anything unusual that day? Because what we're about to uncover next is going to change how you read every crash from now on. And yet, with all this selling pressure, one group that should have been buying stayed completely silent. At 69,000, a level the market assumed was heavily defended, the buyers didn't show. The corporate whales, the treasury holders, the structural backstops, silent. Why? Not because they didn't believe in the asset, but because belief doesn't override balance sheets. Recent tranches of acquisitions were now underwater. Equity pressure was mounting on their own stock. Risk committees don't greenlight knife catching. With no mandate to deploy fresh capital into volatility, there was no discretionary bid. The market learned something uncomfortable that day. A support level can exist without a defender, and when the defender doesn't show up, the floor disappears. When the break came, it didn't unfold gradually. Liquidations didn't cascade step by step. They triggered vertically. Long positions clustered near 69,000. Traders who bet the house on support holding were erased in rapid succession. This is what forced selling looks like. It's not choice, it's not fear, it's mechanics. The cold math of the liquidation engine. Your collateral is insufficient. Sell now. At that point, price stopped being information about value. It became a consequence of leverage. And as the market buckled under mechanical stress, one on-chain signal stood out. Not just because of size, because of history. We tracked a wallet. This wasn't a new whale. This wallet belonged to a legacy infrastructure entity, a figure from the early days of crypto, a holder with the ability to move real, vintage liquidity. Within hours of the 69,000 break, 5,000 Bitcoin were transferred to Binance. 2 large, clean transactions. No fragmentation, no disguise. Whether those coins were sold, posted as collateral, or positioned for optionality, the market didn't wait to find out. At fragile moments like this, markets don't react to certainty. They react to the possibility of supply. And when a holder with that kind of structural history moves size during a crisis, can this level absorb it? At 69,000, with the ETF selling and the corporates silent, the answer was no. Put it all together. This wasn't a loss of faith in Bitcoin. It was the removal of a fragile layer, a layer built on leverage, correlation, and false certainty. 69,000 didn't fail because belief failed. It failed because the structure supporting it couldn't survive the combined stress of ETF outflows, option hedging, forced liquidations, and legacy supply threats. Markets don't care about narratives. They care about who is forced to act and who is free to wait. The selling stopped where the forced sellers ran out. Once leverage was flushed, once liquidation engines went quiet, price found a zone where selling became optional again. That's not a bottom call. It's a structural observation. Mechanical selling always exhausts itself. This doesn't guarantee safety, but it tells us this. The move down was driven by obligation, not emotion. If you want to monitor what replaces the structure that failed, ignore the price predictions. Watch the flow. Watch the IBIT volume normalize. Watch where new structural bids form. The market didn't break because it panicked. It broke because something underneath it snapped. Price just showed us where. Structure over sentiment. Evidence over emotion. This is market signals. If this breakdown helped you see markets differently, you know what to do.